All right, let's jump right in. There's this core bargain at the heart of modern finance. A really simple idea. If you take on bigger risks, you should get bigger rewards. It's rational, it makes sense, and it underpins almost everything. But what happens when the real world just refuses to play by those rules?
So, this was the bedrock principle, right? The theory basically says that any risk that's tied to the whole economy, the kind you really can't diversify away, it has to come with a reward. That's the premium you demand for holding a risky asset. It's the foundational deal of investing. And this is where it gets really interesting. Because theory is one thing. It's clean, it's elegant. But the data? Well, the data was telling a completely different story. Yeah, this is the moment where that beautiful, clean theory runs headfirst into messy, complicated reality. A massive gap opened up between what the models predicted and what the historical data was actually showing. And it created one of the biggest challenges in the history of finance.
Now, of course, everyone expected stocks to outperform safe government bonds. I mean, that's the whole point of a risk premium. But the sheer scale of it was just shocking. It wasn't a little better, it was dramatically better. We're talking several percentage points year after year for decades on end.
So this enormous, unexplained gap was given a name, the equity premium puzzle. And it's a puzzle because the size of that premium, that extra return you get from stocks, seemed to totally defy the rational models that were, at the time, seen as the pinnacle of financial theory. The heart of the puzzle wasn't about whether a premium should exist. It was all about its magnitude. The numbers just didn't add up. The reward you got for holding stocks seemed completely, wildly out of proportion to the risks the models were actually measuring. To make the math work in the existing models, the average investor would have to be almost pathologically afraid of risk. Seriously, we're talking a level of caution so extreme it would mean turning down a bet with a 50-50 chance to either win $100 or lose just one. It was a level of risk aversion that just doesn't match how real people behave. So look, this wasn't some minor error you could just tweak a number to fix. This was a deep, structural problem. The models were built on the idea that what we really fear are big swings in our consumption, our spending. But in reality, our overall consumption is actually pretty smooth. So why was the compensation for bearing such a seemingly small risk so gigantic? So here is the conflict in a nutshell. On one side, you've got the prediction. Rational investors facing pretty small economic wobbles should only demand a small extra return. But then you look at the reality, the data, and you see this massive, outsized return that makes the model look totally broken. Something fundamental was clearly missing from the picture. So what do you do when your model is broken? You don't just throw it out. No, you start asking a better question. The puzzle didn't kill finance theory. Actually, it forced it to grow up. The big response was to ask, okay, if our old definition of risk is wrong, what are investors really afraid of? And this question sparked this incredible creative explosion, with researchers rethinking the very nature of risk itself. This led to some really cool new ways of thinking. First, what if the real risk isn't those small, everyday fluctuations, but the tiny chance of a huge economic disaster, like another Great Depression? Investors might demand a huge premium for that terrifying possibility. Then there's this idea of habit, that maybe risk is relative. Maybe we don't just care about our absolute wealth, but how it compares to the standard of living we're used to. A loss that forces you to change your lifestyle just feels so much worse. And finally, maybe the key risk isn't even the broad economy, but the health of the financial system itself. If the banks and institutions holding everything together are fragile, well, that's a whole different kind of vulnerability. At the end of the day, the puzzle's greatest contribution was what it told us about our own understanding. It wasn't just some quirky data point, it was a profound message about the limits of our theories. This just reframes the whole issue perfectly. The equity premium wasn't just an anomaly, a weird outlier you could just ignore. No, it was a signal. And a signal is something you absolutely have to pay attention to. So what was the signal telling us? It was simple, really. It was saying that our original theory of risk, the one based on those simple, smooth consumption patterns, was fundamentally incomplete. It just wasn't capturing the full spectrum of what makes investors feel vulnerable. And look, this isn't just some academic debate. If you get the definition of risk wrong, you get the price of risk wrong. And when that happens, capital, money, flows to all the wrong places. It can fuel dangerous bubbles in one area while completely starving other innovative parts of the economy. That gap between theory and data can become economically dangerous for all of us. Which leaves us with this critical, ongoing question. The equity premium puzzle forced finance to confront its own blind spots. It proved that risk is way more complex than just a single number, and that to understand the price of capital, we first have to understand what people are truly afraid of. So, if our models are still trying to figure out what true vulnerability looks like, how confident can we really be in the market prices we see every single day?